Hello, everyone, and welcome back to the Moneyball Method Podcast. This is Mark Shupe, the author of the Moneyball Method, a middle-class manifesto for objective investing. And what I'd like to do today is talk about the elegance of markets. I believe that we live in a culture, in a society that does not understand or appreciate the information, the knowledge that we can learn from market price fluctuations. We don't understand the efficiency of markets, the elegance of markets, and I'm going to do that in the context of something completely different, the game of chess. So before getting into the game of chess, I would like to define the term elegance. What is it? Essentially, it breaks down into four elements. Elegance includes efficiency. Efficiency is completing a task thoroughly and with the least energy expended. There's also simplicity, the solution with the fewest number of variables. Elegance also includes genius, the perfect application of intelligence to a complicated problem. And lastly is grace, the aesthetic quality of efficiency, simplicity, and genius. To me, markets, when left alone, accomplish all of this. But more specifically, what are markets? They begin with value creation by producers. This is Say's law of markets. This is fundamental to all sound economic theory. And then there is voluntary trade for mutual profit. This is the trader principle. This is essential. Third is the flow of money for goods and services. In fact, that is what the science of economics studies, is the flow of capital and the production of goods and services. But lastly, and perhaps neglected most frequently, is the fact that markets are prices. Markets have highly decentralized information in the form of prices, and this price information is priceless. But we live in a culture that demonizes money and profits and denigrates markets and prices. For example, we have social justice activists demanding equality of wealth. We also have economic analysts demanding fair competition. We also have investment strategists advertising mispriced securities. And then there are the central planning authorities demanding control over the markets. And this brings me to something I noticed a couple of weeks ago, a series of articles from a number of different outlets in the financial press talking about some research that was conducted by J.P. Morgan Investment Management. Using artificial intelligence, AI agents that had access to the universal database of knowledge available on the internet, they had done simulations. They had devised methods using artificial intelligence to outperform a generic portfolio of 60% stocks and 40% bonds. Now, what is a 60-40 portfolio? It is generally considered a balanced, relatively conservative strategy, and it is a benchmark for how balanced portfolios might perform if they use indexes for stocks and bonds. However, the AI agents were able to increase or decrease their stock market exposure, meaning their exposure to risk assets, their allocation to stocks, up and down, depending upon market and economic conditions at the time. So you might ask, how much outperformance did J.P. Morgan gain using AI agents against a 60-40 portfolio? In these studies, the outperformance over a 20-year period was 0.70%. In other words, 0.7% outperformance, average annual outperformance over a 20-year period. And the AI agents considered 4 different economic scenarios when they were modeling their tests. One is what they call the Goldilocks economy. Economic conditions with moderate economic growth and relatively low inflation. In other words, just right. Another economic scenario they modeled was stagflation, which means a stagnant economy or perhaps a recession, but with price inflation. The third scenario that they modeled, they called reinflation, a higher growth economy with much higher inflation. And lastly was risk-off markets. These are stock market conditions where investors are going toward lower volatility, more conservative stocks instead of more highly volatile, smaller companies. However, those four regimes, in my opinion, eliminate, ignore, dismiss the only regime that really matters. That is the one that we have experienced since the 1790s in the United States of America, and that has affected the rest of the world in very positive ways. And that regime is falling prices and mass prosperity. It was triggered by Alexander Hamilton's, the Treasury Secretary of the United States of America, sound money policies after the Revolutionary War and the ratification of the U.S. Constitution in the 1790s. Now I'd like to switch gears. I would like to compare the current state of markets and the regulatory environment that we face with the game of chess. First of all, let's consider chess to be a closed system. A closed system meaning there are 64 squares on the board. That never changes. There are two players in the game of chess. That never changes. Each player has control over 16 pieces. That never changes. And there are 6 different types of pieces. Each piece has different attributes that define what it can do. And also, the game of chess has objective rules. Each player knows what the rules are before the game begins. They have agreed to that set of rules, and those rules do not change. Again, a closed system. But they have something else. Each player has perfect knowledge over the positions on the chessboard. There are no secrets. Everything that is going on at any moment in time in the game of chess that is on the board is readily available and visible to the players. Now let's look at the game of chess in a little more detail. After the board is set up and white goes first, white has 20 possible first moves. With 8 pawns on the second rank, they can move any one of those 8 pawns forward, either 1 square or 2 squares. That's 16 possible moves. In addition to that, on the back rank are the knights. The knights can jump over the pawns onto one of 2 squares. There are 2 knights. There are 4 possible choices to move a knight, a total of 20 moves per player. There's 2 players. 20 times 20 is 400. There are 400 possible combinations of first moves once both players have moved once. What happens after that? Without doing the math explicitly, there are almost 200,000 possible combinations of first and second moves for each side. Because once a pawn has moved, players on the back rank now have mobility. They now have space. They can now break through the second rank. So after 2 moves, there are 200,000 possible combinations possible on that board. Let's talk about the first 4 moves. According to the math, there are over 300 billion possible ways to play the first 4 moves in a game of chess. Now, instead of going on with this infinitely, I'd like to cite the work of a mathematician from MIT by the name of Claude Shannon. He calculated the number of possible moves in the closed system of a game of chess, assuming each player moves only 40 times during the entire game. 40 times 2 is an 80-ply system. Claude Shannon was able to calculate that the number of possible moves in the game of chess possible combinations after 40 moves by each player was 10 to the 120th power. That is 10 with 120 zeros after that. Now, this is way beyond my scope of imagination, knowledge, and understanding, but I understand that that is greater than the number of atoms in the known universe. It's a big number. Who is Claude Shannon? Why should we believe him? Not only was he a mathematician from MIT, but in 1937, he established the theory behind digital computing. So let's fast forward from 1937 to 1989. 52 years of digital computing under our belts. 52 years and many millions of dollars later, IBM's Deep Thought chess computer challenged the world champion Garry Kasparov to a 2-game chess match. By then, Deep Thought, IBM's fastest, most powerful machine for playing chess, could process 700,000 positions per second. Garry Kasparov won both games. 7 years later, and many more millions of dollars later, IBM challenged Garry Kasparov again with its Deep Blue machine. This time, it could evaluate 100 million positions per second. Garry Kasparov won the match 4 games to 2. No one remembers those 2 matches. What we do remember is the match that was set up in 1987. IBM was determined to win at all costs. In another 6-game match, it hired a team of grandmasters to help program Deep Blue's software to understand Garry Kasparov's tendencies. They wanted to win the match. Of course, so did Kasparov. Deep Blue ended up winning 3.5 games to 2.5 games with the help of the team of grandmasters, but on top of that, they were able to change the algorithm between games and in some cases intra-game, eliminating Garry Kasparov's advantage for understanding the tendencies of the computer. But let's compare that to markets. What if the number of pieces for each player were increased? Certainly all of us have access to more than 16 pieces on a chessboard. We have access to hundreds and thousands of different choices at any given moment in time, if we so choose. What if the number of squares were increased from 64 to hundreds or thousands? Or better yet, what if the rules were constantly subject to change, as they are in a mixed economy? And on top of that, what if there is more than 2 players? After all, we do not operate in a barter system economy. What if there were 200 million players in America, people that were actively producing, consuming, and trading? Of course, there may be a lot more than that, instead of just 2 players. Now, we also mentioned that the number of possible moves in a game of chess is greater than the number of atoms in the universe, but let's reduce that. What if the number of possible moves in a game of chess in a closed system with 64 squares was limited to the number of atoms in the Milky Way galaxy? Or better yet, what if it was limited to the number of atoms in our solar system? Or better yet, what if it was limited to the number of atoms that are streaming through the arteries and veins of your blood system? Could any government committee manage this disaster more effectively than the price discovery mechanism of free markets? Absolutely not. It is ridiculous. It is insane. But all of the regulators, all of the central bankers, all of the politicians exist because they believe in one thing: that markets are unjust, that markets are inefficient, that markets fail. And I am here to say emphatically, using the game of chess as unassailable proof, that markets do not fail. But they can disappear. And they did so for 1,000 years in the West. Now let's talk about the latest crisis that is on the lips and tongues of every politician of both parties and of all parties, for that matter, in the United States and mostly throughout the world, and that is the debt crisis. What I'd like to talk about is the debt crisis and the Treasury bond market. For example, conservatives demand entitlement reform and lower taxes to increase tax revenue in order to pay off debt and solve the debt crisis. Progressives demand higher tax rates and government investments for greater tax revenue to solve the debt crisis. What they fail to understand is that there are two sides to every transaction. First of all, there would be no government debt if there were no bond buyers. There would be no deficit spending if there were no bond buyers. There would be no bond buyers without strong cash flow to service the debt. Investors are not stupid. There would be no strong cash flows without the amazing value creation of America's producers. And there would be no strong cash flows to service the debt without the taxing power of the state. We cannot ignore the nature of government. The nature of government is to spend. The nature of progressive government is to destroy as much as they can possibly tax and borrow. We do not have a debt crisis as much as we have a tax and spending problem. In summary, the primary cause of the debt crisis is the taxing power of the state. The real crisis is not the debt. The crisis is taxes, spending, and perhaps even more importantly, what could have been if this money had been invested privately. If there were a debt crisis, interest rates would be as high as they were in 1981 or higher. However, since 1981, when the federal debt was $100 billion, not $32 trillion, the Treasury bond market rallied for the following 39 years. It did not fall sharply until 5 years ago, thanks to the supply-side disaster known as the economic lockdowns, which were the panicked response of government officials who believed they know everything, and that created the inflationary spiral that we noticed that began in 2020. However, the bond market crash between 2020 and 2023 has leveled off. So we had a 2.5-year sell-off in bonds starting 5 years ago, but the last 2.5 years, interest rates and bond prices have pretty much leveled off. The Treasury bond market is telling us that there is not a debt crisis. The Treasury bond market, like all markets, reveals tremendous information. Money isn't stupid, and bond buyers have confidence. Everyone trying to predict and control capital markets is evading reality. Accordingly, the Moneyball method ignores economists, strategists, and analysts. We control what we can control. We invest in capitalism, and we are able to answer the most important question: to make money for what? Thank you for joining me today. I hope you found this comparison between markets and the game of chess to be convincing, educational, and maybe a little entertaining. And I hope to see you next week.